Welcome back, investors. Jake here. For those of you who have been following my channel for a long time, perhaps you saw this video coming, but in today's video, unfortunately, I am announcing that I will be taking a break from making finance and investing content on this channel. I've been operating this YouTube channel for 3.5 years, and if we go back to last February, I was at about 80,000 subscribers. I was perfectly happy with the growth I was experiencing, perfectly happy with the audience I had. But since I started talking about the war between Russia and Ukraine, my channel has kind of exploded. I've gained an additional 140,000 subscribers in the last 6 months. And when I look at the YouTube analytics of my audience watching my videos, 70% of my audience now is living outside of the United States. I have lots of subscribers and supporters in Canada, Australia, New Zealand, the UK, and Europe. I greatly appreciate all of you for supporting my channel and watching my videos. But prior to last February, I talked about finance, investing, credit, and taxes, and mostly options trading or short-term trading on the New York Stock Exchange, the US stock market. And ultimately, it comes down to a question of use of my time. If I produce a 15 to 20 or 25-minute video, realistically, I can only make one of those a day. So it's a question of, do I want to talk about current events and geopolitics that's applicable to a much broader audience, or do I want to continue serving a niche audience where I get much fewer views? So if we go back to February, looking at some of my finance and investing content, I typically got between 5 and 10,000 views. If a video went over 10,000 views, I viewed that as a great video, huge success. But let's just be realistic that the audience looking to watch a 13-minute video about risk-free debit spread options on Apple, it's a very small audience. Whereas if I spend an entire morning producing a 20 or 25-minute video talking about current events or the war in Ukraine, I had 3 videos in a row last week get over 400,000 views. So to get that many views from an investing video, investing content, I would have to make 40 videos to equate one video talking about current events and the war in Ukraine. So for that reason, it just seems apparent to me that I should shift the focus of this channel. If you've been with me a long time, if you've been with me for years, I greatly appreciate you. The name of the channel is Jake Bro. That's my name, and hopefully you'll continue to support me going forward. Now, I'm not saying I'm not going to talk about finance or investing topics ever again. I definitely will, as I think it's all interrelated and connected to global conflict, the global economy. I think there's going to continue to be lots of disruption and somewhat chaos going forward in the near term. So in this video, let's talk about the global economy and the US stock market, and what do I see as happening? Where do I think things are going in the short term? So here is the S&P 500 performance over the last 6 months, and I think everyone on Wall Street was hoping that the US stock market bottomed out on June 16th, and we experienced a very nice summer rally where the S&P 500 was up over 17% over 2.5 months. But on August 16th, we experienced a local high, and the stock market has once again sold off by 10%. So here's the S&P 500 chart looking back 5 years. These colored lines are the weekly moving averages. Each one of these candles represents an entire week of trading on the New York Stock Exchange. And I'm still convinced that at some point this year, in the next 3 months, the S&P 500 will fall below this purple line, which is the 200-week moving average. So if you're holding on to cash and you're wondering What's a good price if you're looking to buy more index funds? If you're below the 200-week moving average, I think that's a steal as far as deploying any cash you might have to invest into the market. But don't be upset if the market continues to go down. There's lots of headwinds facing US stocks, and I'll explain exactly why. The biggest and most obvious one is that inflation is still out of control. What reversed the market here in August was the inflation reports that inflation, despite fuel prices going down, did tick up in August. This was August over July. Everyone was hoping the market had peaked in June because the inflation number went down in July. Doesn't look to be the case. What this means is that Federal Reserve Chairman Jerome Powell is going to have to be much more aggressive raising interest rates for the rest of this year in order to get this inflation number down. Inflation might not be back under 2%, possibly well into 2023 or maybe even early 2024. Just speculation, but there are lots of people on Wall Street now pricing this in. The Federal Reserve is meeting 3 more times this year, September, November, December. Everyone is already expecting a 75 basis point hike for September. There might be another 50 or 25 in November and December. So what does this mean? Currently, the federal funds effective rate is 2.3. If it goes up 75 basis points this month, it'll be over 3. This means it's more expensive to get an auto loan, more expensive to get a small business loan. And the biggest impact I think that the federal funds effective rate has is on the housing market. So here is the national average for a 30-year fixed rate mortgage here in the United States, and it's back at 6%. Everyone in 2020 or 2021 that got a 30-year fixed rate mortgage close to 3%, congratulations, never refinance, hold on to that property as long as possible. But for suckers like me looking to buy a house early next year, we have a serious problem. And for those who don't know my backstory, I'm currently renting because I couldn't qualify for a mortgage. In order to claim my YouTube income, to qualify for a conforming loan, I needed 2 years worth of tax returns, and they averaged my income over those 2 years. So I wanted to move to Vegas and buy a house. I didn't qualify. I decided just to rent for a year. So I am looking to buy a home in early 2023 after I do my taxes. But if the Fed is going to raise interest rates by 75, 50, and 50, I'm looking at a 30-year fixed rate mortgage closer to 9% now. And if you think about it, why do people tell you if you've got a 30-year fixed rate mortgage at 3%, never pay that down, you're basically at the cost of inflation? Instead, invest that money in the markets. The long-term average of the S&P 500 is about 10% a year. So if you have a 3% fixed rate mortgage and you put your money in the market that earns you 10, you're net making 7%. This makes sense. But if I buy a house next year and my mortgage is at 9%, why would I put any money in the stock markets buying index funds hoping to get 10% when I can get a guarantee savings on my money by just aggressively paying down my mortgage as quickly as possible? Now, this is a short-term game. Eventually, at some point in the future, there's going to be an economic collapse, and the Fed will once again lower interest rates to about 0%. It's at that point that I would cash out, refinance my mortgage. All the money that I had put in while interest rates were high, I would take that money out, refinance hopefully closer back to a low of like 3%, and then I'd probably take that money and dump it into the stock market. But what this means is that in 2023, if I'm paying a mortgage at 9%, I don't think I'm going to be doing a lot of investing in the stock market. And I don't think a lot of other investors will as well if they're experiencing higher interest rates on borrowed money. You can already see the real estate market softening. Las Vegas is one of those extreme examples of experiencing high highs and low lows depending on how the economy is doing. I live on the south side in Henderson. I'm not going to show you exactly where I live, but I will tell you that the house next door to me is selling for about $500,000, and it's been on the market now for over 3 months. The owners of this home cannot sell. And when I just skip around on Zillow in Henderson, this house is going for $465,000, been listed on Zillow for 75 days. This house selling for $460,000, listed on Zillow for 81 days. This house listed on Zillow $500,000, listed on Zillow for 88 days. This family, or this homeowner, did everything correct. They listed their house at the beginning of the summer, hoping to sell before kids have to go back to school in the fall, and they couldn't sell. This house, if it had been listed at the end of 2021 while interest rates were still zero, it would have been an all-cash offer, sold, within a week. The housing market was going crazy just 9 months ago. So when we look at the Zillow estimator for this home, if we go back even 5 years, this was a $300,000 house. It then doubled in value when everyone was going crazy, buying property at the end of 2021. Zillow estimate close to $600,000. This family is now trying to sell it for $500,000, even did a price cut, and it's still probably overvalued, and the value of this property is probably still going to continue going down. So I'm not calling it a housing crash. It's really just a softening versus kind of like an equalizer. Housing property values shot up way too high in 2020 and 2021 as everyone was crazy to buy. They're now basically reverting to the mean where their values should have been based on natural growth in the market. Individual stock picking, in my opinion, is also a huge risk at the moment because a single piece of news will completely devastate a stock. And if you don't trade within seconds after market close or pre-market opening, you're not going to get the jump on Wall Street. So FedEx shares took a nosedive after the CEO announced weakening global demand. So the share price of FedEx was down 23% this week. Adobe announced an acquisition of a company that was valued at 50 times sales. They announced this as a cash/stock equity offering. Investors were not happy. Adobe was down 23%. And all time, holy cow, going back to last November, Adobe is down 56%. Meta also got crushed this week, down 14%. People are talking about a leadership crisis at this company. What are they doing? The entire market looked bad. Microsoft down 7, Google down 7, Nvidia down 8, Amazon down 7. So there's a mixture of factors that are all converging that is bad news for the global economy. One is that Asia is in recession, and there's lots of political tensions right now between the United States and China. The United States is considering sanctions to deter China from invading Taiwan. They've already, I think, put restrictions on Boeing to selling aircraft parts to China. There's also now restrictions being placed on semiconductor manufacturers. This has greatly affected Nvidia's stock price. They're no longer allowed to sell advanced chips to China because potentially some kind of armed conflict might be coming in the near term. China's economy is also a mess. You can't really trust their numbers as they cook the books, but China's property market is in freefall. What does this mean for the world economy? And Chinese stocks could plunge 20% if real estate troubles get much worse. This is according to Morgan Stanley. China's a little weird in that people don't really have faith in their stock market, and everyone in China invests their money by buying property. And often this is property that nobody uses and nobody lives in. People only buy it hoping that someone down the road will pay more money for it. This created a bubble, a house of cards. It could collapse at any moment, and this would obviously reverberate greatly through global markets if Chinese companies start defaulting on their debts, or they're not good for their loan contracts. China also 3 years later is still struggling with COVID. China put 65 million people into semi-lockdown ahead of a party summit. Offices, schools, and shops closed before Congress, at which President Xi was expected to get his third presidential term. This isn't supposed to happen in China. President Xi is basically a dictator for life now. He's going to die in office. He's never going to leave. And what's happening in China with their COVID-19 is that they don't have an mRNA vaccine. In Europe and the United States, we have Pfizer and Moderna, much higher efficacy rates than a traditional vaccine comparable to the Johnson & Johnson. So what China did is they didn't develop an mRNA vaccine. They used traditional vaccine technology, and their vaccine doesn't work. So if China doesn't do these lockdowns and they just let COVID spread wildly throughout their population, I'm not overestimating that, based on projections, maybe 40 million people would die in a couple months if they didn't do these lockdowns and they just let the virus spread. So what China has to do is develop their own mRNA vaccine because they refuse to take Europe or America's existing vaccines. So this is how crazy things are in China. This video was taken at a Costco in Shanghai, and it was about to be locked down. There was an announcement, I guess, on the PA, and they told everyone, get out of the store now, otherwise it will be closed, and you'll have to remain in the Costco store for 2 days, 48 hours. So here's the video.
完了，泰斯克都在往外跑了，全部在往外逃了。现在，我天哪，说不逃逃不掉了，真的假的？我他妈刚进了啊！
Absolutely insane. You can see, look at all these shopping carts of customers who were just trying to do their ordinary shopping, and then they just started running for their lives as they didn't want to be trapped inside a Costco for 48 hours. Wow. Europe's not looking much better. Their economy is also experiencing severe inflation, so the European Central Bank could unleash a jumbo rate hike as the economy slides deeper into recession. Here's a scary headline. Germany seizes Russian oil firm Rosneft's refineries. Russia finally cut off all gas flow through the Nord Stream pipeline to Germany. This is going to greatly affect the German economy, the entire European economy through this winter. And the economic cooperation and relationship between Germany and Russia has officially ended. Rosneft is the Russian oil and gas giant, and Rosneft's German subsidiaries are being placed under trusteeship to counter the threat to the security of Germany's energy supply. So Germany just seized billions of dollars worth of assets belonging to Rosneft and have put them under state control. So even if somehow this war between Ukraine and Russia were to end, I don't think it would be a simple matter of just turning the gas back on anymore. There's now legal complications and legal disputes, once again, as Germany is seizing Russian assets because they're done ever doing business with Russia. Russia's invasion is also sparking international conflict amongst other international actors. How Russia's invasion of Ukraine is reshaping the Armenia-Azerbaijan conflict. In addition, breaking just the last 2 days, Kyrgyzstan and Tajikistan are now reporting heavy weapon use in a border clash. Georgia is also mulling holding a vote on fighting to regain land in their 2 breakaway provinces that Russia recognizes and supports. So here's the map, and this is a lot. This is everything currently going on, but Armenia and Azerbaijan are now fighting. Azerbaijan is allied with Turkey. Armenia is allied with Russia. What's happening here is that Russia is the regional hegemon in the Caucasus and Central Asia, and nobody in the Caucasus or Central Asia is allowed to fight without Russia getting involved or Russia being a mediator. Because Russia is showing weakness by not being able to get control of this conflict in Ukraine, everybody else in the Caucasus and Central Asia is now seizing this as an opportunity to resolve old disputes. So in 2008, Russia invaded Georgia, and they basically recognized these two breakaway regions and gave them their independence. Georgia is now saying 6 months, 7 months into this war, Russia is looking weak. This might be the time to retake these breakaway provinces. The next dispute is between Kyrgyzstan and Tajikistan. These are both supposedly allies of Russia, so I mean, when you look at this border, can you believe they're having a border dispute? They're arguing over mostly water and mineral rights. Additionally, there's always Israel. With Russia showing weakness, this might be Israel's time to strike at Syria or even strike at Iran. There's always conflict there. And then finally, this is crazy, but China is warning Russia against meddling in Kazakhstan ahead of Putin meeting. So what this means is that Kazakhstan, being on the border with Russia, is always nervous about being attacked or invaded by Russia. So Kazakhstan is asking China for security guarantees. They want to ally themselves closer with China against Russia. And all of this ignores the obvious fact that if Russia experiences political turmoil or political collapse, if they continue to show weakness, I think it's only a matter of time before China mobilizes their military to take action, and I think they're going to try and retake this outer Manchuria land up here that belonged to the Qing dynasty just 150 years ago. Russia stole this land from China in the late 1800s under their century of humiliation, their century of weakness in which European powers were carving up China. And China has reclaimed all of their territory and land from the Japanese, the Germans, the French, the Portuguese, the British, but they never got back outer Manchuria from the Russians. So that's going to continue to be interesting over the next 6 months. The final and potentially maybe strongest headwind against stocks continuing to go up this year or even next year is that the U.S. Treasury yields, this is America's debt, this yield is going to continue to rise if the Federal Reserve is done buying U.S. bonds. When the Fed buys U.S. Treasury bonds, in effect, they're printing money out of nothing in order to artificially keep this yield down. But this is one of the tools that the Fed has to fight inflation. If they just stop buying U.S. Treasury debt, this yield has to rise in order to attract bond buyers. And if you're a government, a foreign government, or a billionaire and you have lots of money, you can either risk it by putting it in equities or startups or real estate, or you can get a guarantee on your money. Unless the United States government collapses, you're guaranteed right now 3.4% on your money every year for 10 years if you buy 10-year Treasury yields. And the stock market is basically inversely proportional, sometimes in the short term, to U.S. Treasuries. You can see that when the Treasury yield spiked back in June, around June 13th, this is when the stock market bottomed out. I think I told you the stock market bottomed out this summer on June 18th. As the yield went down, stocks went up because buying bonds didn't look as attractive to large investors. But since the beginning of August, the yield has been going back up, and this is causing selling pressure on equities, on stocks. So the yield is currently at 3.4%. I think this is going to easily get above 4, might even get closer to 5. And at 5%, I think I can think of a lot of people that would happily take 5% guaranteed every year on their money rather than risking it in stocks. So going to the charts, I don't even see a point in doing this anymore. News is what drives the stock market, not fundamentals, not technicals. Breaking news will cause stocks like FedEx or Adobe to go up 20% or down 20% in a day. So I'm done trying to predict stocks or the market in the short term. I do want to focus my own personal investing more on long-term, buy and hold forever kind of investing. So I'm currently holding a lot of cash. I've actually not put any money into the stock market at all this year, just stockpiling cash. And I'm going to wait until 2023 in January to see if I want to buy into the market. I'm suspicious that, once again, index prices will be much lower. But other than that, I might save that cash and just put it towards my mortgage to save me 9% a year on my money if mortgage rates get that high. Something I do want to point out to you about this chart is look at the trade volume that occurred on Friday, September 16th. I don't know what spooked the market, but there was a flurry of trading. I think the S&P was only down about 1% or so, but you'll notice on Friday there was a huge amount of trading, more than pretty much at any point the entire summer. We have to go back to mid-June to see an amount of activity and trading similar to that. For those of you following my massive short position on the QQQ, I did sell to close everything on Thursday. Here's a screenshot of my account of what I got. I didn't know the market was going to be red on Friday. I just saw that the QQQ was negative almost 2% on Thursday, so I did sell to close whatever I could get for these contracts. I'm still taking a massive loss as I horribly mistimed this, and I got punished. I don't like losing money, and this is why I think I'm giving up short-term trading. There still is about $6,600 in this account. And full recap of what is my active trading account in Schwab been like the last 2 years, we have to go back to January of 2021. I put $25,000 cash in this account and didn't add any money. My only goal was to trade this up as much as I could get it. The account peaked in January at $66,000. I thought I was a trading savant because I basically bought call contracts and everything went up in 2021. I then stayed long as the market sold off and got horribly punished. I then shorted the markets as we had this summer rally and got punished even more. So I am going to be pivoting how I choose to invest my money. I make a very good income from YouTube now, and I don't want to lose money trading short-term options. And this was an experiment, a test, proving that I can't do it. As much as I want to believe there is this science to technical analysis or technical trading, or even fundamental analysis, trading options in a short term, 1 to 6 months, you're just not going to get good results. And that's the conclusion that I can draw from all of this. All right, that's all for this update video. I've been talking a long time. If you've made it to this far in the video, you're a true all-star. I greatly appreciate you. Hopefully you also get value from my current events and geopolitics content. I will keep producing videos and posting possibly 3 or 4 times a week, but I just won't be talking about the US stock market as much in the near term. All right, that's all for this video. If you found it informative, thumbs up. Comments or questions, let me know. Till the next video, take care.